have with us Sunil Duggal, the former CEO at Dabur, and we also have with us Arvind Singhal, Chairman and MD at Technopak Advisors, joining in on the show right now. Gentlemen, both of you, thank you so much for taking the time out and speaking with us today. Sunil, I want you to don your ex-Dabur hat, and I want you to, really tell us, because times must be really rough right now for the FMCG sector, right? I mean, it's a bit of a tightrope walk. You've got food inflation being as high as it is, other cost pressures as well burdening. Sure enough, you have that option of, passing on the entire inflation on to consumers, but you've got to be extremely cautious because even the consumer is going to be very conscious of how much they're spending and what they're spending on.
Yes, it's tough times for the FMCG sector. I think the worst we've faced for the last decade or so. The last I remember this type of inflation and demand crunch was perhaps in 2010-11. Having said that, I think that things are only going to become worse. Because inflation, if you see the headline CPI numbers, they aggregate at around 6%. The lead indicator is actually WPI, which is topping out at 13%. And only now are we seeing the oil prices spike in terms of the end cost. Diesel went up by almost ₹1 today. LPG went up by 50 rupees a cylinder. And whether we like it or not, these are going to continue to spike up and fuel inflation further. So I do expect inflation to accelerate. Now, there's a double whammy here for FMCG. One is the input cost increase, which is squeezing margins. And the second is a generally lackluster demand on the back of a slowing rural economy and income compression at all levels. The government hasn't helped by not really giving any kind of succor to the market, to consumption, which was expected in the budget. So all in all, these are tough times. How long will it last? I don't know. But I do think that the next few quarters are going to be very tough. And it's already reflected in the stock prices of FMCG majors.
Really the key thing, because, like Sunil is just pointing out, to add to all these inflationary pressures, you're also seeing a slowdown in rural demand. So, I mean, are we headed in for a space of further earnings pressure for the entire FMCG sector per se?
Yeah. So, Sunil is optimistic when he's saying next couple of quarters. I unfortunately feel even more pessimistic about the overall prospects for the FMCG sector, at least for 1 year. So in addition to all the points which Sunil highlighted, which are the headwinds to the sector, there's one more factor we need to also keep into mind. The consumer behavior during the COVID and post-COVID has also undergone some kind of a change. As the economy opens up, as the COVID restrictions sort of go away, people are tending to spend a bit more money on things they could not do in the last 2 years. Travel, leisure, recreation, variety of other services. It almost like a spring, which was compressed artificially and is bouncing back. So you have not only compressed incomes of the consumers by and large, but even the allocation of those incomes is likely to see a change, already being seen that over the next 12 months. So even if consumer incomes start to rise, economy does well, as it is shown that it might bounce back to post-COVID, pre-COVID levels plus some growth, the discretionary money will not come necessarily toward FMCG. So all in all, very, very pessimistic times for most FMCG companies, I would say.
I mean, define pessimism. What do you mean by pessimism? Will it be a margin squeeze? Will it be a drop in terms of sequential growth? Will it be a category reorientation, or it could be bada packet becoming chota packet?
So I think the way I see pessimism in this case is, unfortunately, both volume decompression and, of course, margin decompression. Margin decompression simply because of the input cost going up. Companies, if they were to try to pass on these costs to the consumers, you will see a dip in demand. And plus, in any case, overall consumption going down, what I explained for the reasons. So unlike in the past, where sometimes you could see volume growth at least, but not margin growth, or sometimes you could pass on the pricing to the consumers, and therefore may not see volume growth, but at least get better margins. The next 4 quarters, at least, I see both volumes under pressure as well as margins under pressure. And that is why I'm using the word pessimism all around in this case.
Do you
I
think
think to
that
your point on down trading to smaller packs, this is a double whammy because A, the smaller packs generate lower tonnage, which is reflected in lower volumes. And secondly, the margin profile emanating out of the small packs, LUPs as we used to call them, is perhaps a fraction of what we get from the large packs. So companies cannot do without the small packs, but quite frankly, they hate to sell them. At this point in time, they have no recourse but to keep pushing the small packs, regardless of the margin erosion, particularly in rural areas. And I think to Arvind's point, he's absolutely right that in urban India, the share of wallet of FMCG has actually shrunk because of diversion of income to discretionary pastimes like leisure and travel, etc., which wasn't available for the last couple of years. In the rural, I think the wallet has actually shrunk. And while the share of wallet may have actually increased in the less affluent rural areas, but if the wallet has shrunk to the extent, then a higher share of wallet doesn't really help. There is still demand compression happening. How long will it last? I'm a little bit more optimistic than Arvind. Things do have a habit of turning around. But there is a worst case scenario that this is a secularly long inflationary period, stagflationary period, low demand, high inflation, which could last us for maybe a year or 2 or 3. I hope that doesn't happen. FMCG has this great virtue of bouncing back, but no reason to be complacent. I think companies just have to tighten the belts, protect market shares, and ride it out. And there's not too much you can do.
could we see a repeat of, let's say, what we saw between 2014 and 17 or 14 and 15, where FMCG margins came under pressure? It was inflation, it was cost pressures. And for example, a Dabur or an HUL, their margins, which were always north of 20, they were getting compromised. Are we in that phase then?
Yeah, but that time, at least from what I recall, there wasn't such a demand issue. The demand remained robust, margins compressed, and we are never uncomfortable with that situation. There's a lot of top line focus in FMCG, and as long as the top line volume growth, as reflected in top line, is buoyant, we tighten our belts and we know things will end. But today the situation is that I suspect FMCG companies will have almost nil volume growths, maybe very low single digits at best, maybe even negative. While the top line may look a little bit robust, maybe in the high single digits or even the low double digits, it's entirely on account of pricing. Now that's never healthy because the key indicator for FMCG health is actually volume growth. And that doesn't seem to be happening at all, at least not in the near term.
So, Mr. Duggal, if it's all based on volume growth, that Nikunj asked that one question: will we see smaller sizing? Because premiumization will obviously be out of the window. And just leaning back on your years of experience and the many cycles that you've gone through, how do you see whether it's a Dabur or its competitors balancing growth and inflation?
You have to keep some semblance of margins. You can't let margins totally collapse. So you have to take price increases. At the same time, you have to look over your shoulder at your competitors. Are you disadvantaged because your competitors have not taken out the prices? And many competitors, especially the smaller players, they are holding on to the price line, which is, again, nibbling away at the large folks' market shares. So, but at the same time, I think I would protect volumes at any cost, even if it means that there's a temporary dip in margins. We can live with that. We'll ride out that cycle. But market share damage via volume compression is something which becomes harder to retrieve. So that has always been my focus at Dabur, and I would recommend this kind of philosophy for most companies, maybe not all.
Right. Mrs. Singhal, what are you also advising? You work with so many brands, you work with so many companies. What would be the advice, and what is the sense that you're getting? Are we going to see price hikes across the board? Because we talk about crude oil, which has a cascading impact. We've talked about edible oils because of the Ukrainian supply disruption, which has taken place. But the cost of everything is going up, from a dairy to a poultry.
So, for consultants, sometimes it's easy to advise, it's not their money. But I would tend to agree with what Sunil said. Picking up 1 point of 100 basis points of market share takes crazy amount of money and effort to do so. The worst you can do in this time is to lose your market share simply because the market is not able to absorb the price increases. So sadly speaking, I think the only advice I can still give to a few clients, not that they need it at this point in time, I think they're very intelligent and smart, is to look into saying it's a cycle. They've seen some good times in the recent past. It's a time now to say that, look, if it's a year or two, and I don't think it's going to be 2 or 3 years, maybe just 1 more year, 2 good years of economic growth. I'm very optimistic about the overall growth in our economy for the next 2 or 3 or 4 years. Just 2, 3 years of good economic growth itself will bring the volume back in any case, with pricing power back with the companies which are able to maintain good market share. So the simple advice is don't panic. If you have shareholders to be taken into interest, into confidence, confidently go out and tell them, look, it is something which is a cycle we are facing. We will be able to face it. Keep expectations well managed as far as investors are concerned, but do not lose the core of your business, which is the share which you have actually built over decades, many decades in many cases. So that's a simplistic advice which I can give. Yes, short-term pain, but I really don't think this pain is sustainable or is likely to be sustained for many long time. Couple of years is all it takes, and both volume and margins will come back.
Okay, gentlemen, let's see what happens to the FMCG sector. But I think what Sunil said in his opening, that the stock prices and the valuations these stocks are trading at vis-a-vis the rest of the market is clearly justifying the fundamental worries around it. But let's see how far this gloom really continues. But Arvind, Sunil, both of you, thank you so much for taking the time out today.